persistently high inflation and weaker economic growth. Many developing economies exited the pandemic with less than full recovery and high debt levels. Russia's war in Ukraine continues to impair production and trade of a wide range of energy, food, and other commodities. The supply of energy to the euro area is limited as winter approaches, placing immense strain on households, businesses, and governments. With rapid inflation and monetary policy normalization, the United States may also experience slower economic growth. While China's recovery from the COVID-19 lockdowns has strengthened, economic growth is expected to remain below longer-term trends. Taking these and other factors into account, the SAP's forecast for global growth in 2022 is revised down from 3.3% in the July meeting to 3% in the currently, and is lowered to 2% for 2023. Although policy settings in advanced economies remain accommodative, policy normalization has accelerated and higher yields are tightening global financial conditions. Asset values in major markets have declined sharply, and investor appetite for riskier assets has weakened further. This year, the SAP expects the South African economy to grow by 1.9%. Growth in the first quarter of this year surprised to the upside at 1.7%. In the second quarter, flooding in KwaZulu-Natal and more extensive load shedding contributed to a contraction of 0.7%. Growth in the third and fourth quarters is forecast to be 0.4% and 0.3% respectively. The economy is forecast to expand by 1.4% in 2023 and by 1.7% in 2024, above previous projections. Private investment has strengthened on the back of the recovery, but public sector investment remains weak. Household spending remains supportive of growth, but is likely to soften next year. Tourism, hospitality, and construction should see stronger recoveries as the year progresses. With a low rate of potential, our current growth forecast leaves the output gap broadly unchanged. The output gap is still expected to turn positive in the second quarter of 2023. After revisions, the risks to the medium-term domestic growth outlook are assessed to be balanced. While negative global shocks and load shedding will continue to create headwinds to growth, household spending and investment are more supportive. Commodity price movements in recent months have been mixed. The global price of coal has increased alongside oil, while metal prices have declined. With oil prices currently sitting at around $91 per barrel, we expect them to stay higher than we did in July and to average $105 per barrel for 2022, $92 per barrel in 2023, and $85 per barrel in 2024. South Africa's export commodity price basket has come down from earlier peaks and is now forecast to rise by 2.3% for the year as a whole, before falling in 2023 by about 17.6% and by a further 10% in 2024. As a result of these export and import developments, the current account balance is expected to register a surplus of 0.2% of GDP this year, before falling to a deficit of 1% in 2023 and 1.6% in 2024. Although near-term fiscal risk has eased on the back of better revenue, financing conditions for rand-denominated bonds have worsened. 10-year bond yields currently trade at around 11%. policy normalization in major economies and the slowdown in China have contributed to rand depreciation in recent months. The implied starting point for the rand forecast is 16 rands 91 to the US dollar, compared with 16 rands 10 cents at the time of the previous meeting. While economic growth is slowing globally, inflation continues to surprise to the upside. Sustained policy accommodation, supply shortages, and other restrictions have sharply increased the prices of many goods, services, and commodities. Producer price increases continue to pass through to wages and consumer prices globally. Our estimate for inflation in the G3 is revised higher to 7% in 2022, up to 3.5% in 2023, and slightly higher at 2.1% in 2024. Since the previous meeting, the easing of global oil prices have contributed to a less aggressive rise in fuel price inflation for this year at 33.7%. Further moderation in fuel price inflation is expected in 2023, averaging 1.7%. Local electricity price inflation is slightly lower at 10.9% in 2022, 8.9% in 2023, and is unchanged at 10% in 2024. Despite reduced global food price inflation, local food price inflation is revised up and is now expected to be 8.1% in 2022. Food price inflation is revised lower to 5.6% in 2023 and remains unchanged at 4.2% in 2024. The bank's forecast of headline inflation for this year is unchanged at 6.5%. For 2023, headline inflation is revised lower to 5.3% as a result of lower food, fuel, and core inflation forecasts. Headline inflation of 4.6% is expected in 2024. Our forecast for core inflation is unchanged at 4.3% in 2022 and lower than previously expected at 5.4% in 2023. The forecast for 2024 is slightly lower at 4.8%. Services price inflation is broadly unchanged. Core goods price inflation, however, is forecast lower in each of the 3 years, largely due to a lower starting point for vehicles and non-alcoholic beverages inflation. Average salaries are forecast to rise by less than expected at the time of the July meeting, at 5.1% in 2022, 6.7% in 2023, and 5.6% in 2024. The risks to the inflation outlook are assessed to the upside. While producer price and food inflation has eased, Russia's war in the Ukraine continues with adverse effects on global prices. Oil prices increased strongly from the start of the war to around $130 per barrel and may rise again from today's levels as stresses in the energy markets intensify. Electricity and other administered prices continue to present clear medium-term risks. Given below inflation assumptions for public sector wage growth and high petrol and food price inflation, considerable risk still attaches to the forecast for average salaries. Higher than expected inflation has pushed major central banks to accelerate the normalization of policy rates, tightening global financial conditions, and raising the risk profiles of economies needing foreign capital. G3 interest rate levels for the forecast period are now expected to be somewhat higher than in July. On balance, and with few exceptions, capital flows and market volatility will be elevated for emerging market assets and currencies. The rand depreciated by about 3% to the US dollar since the July meeting. An additional tightening of global conditions will present further risks to the currency. The risks to inflation identified over the past year have been realized, pushing up South Africa's headline inflation rate and inflation expectations. Average surveyed expectations of future inflation have increased to 6.5% for 2022 and 5.9% for 2023. Expectations for inflation based on market surveys have increased to 6.7%. Long-term inflation expectations derived from the break-even rates in the bond market have moderated slightly to about 7%. The second quarter of this year saw headline inflation breaching the target range and is expected to remain above it until the second quarter of 2023. By the fourth quarter of 2024, we expect headline inflation to revert to the midpoint of the target range on the back of declining fuel and food inflation. The forecast takes into account the policy rate trajectory indicated by the bank's quarterly projection model. As usual, the repo rate projection from the QPM remains a broad policy guide, changing from meeting to meeting in response to new data and risks. Against this backdrop, the MPC decided to increase the repurchase rate by 75 basis points to 6.25% per year with effect from the 23rd of September 2022. 3 members of the committee preferred the announced increase. 2 members preferred a 100 basis points increase. The level of the repurchase rate is now closer to the levels prevailing before the start of the pandemic. The revised repurchase rate path remains supportive of credit demand in the near term, while raising rates to levels more consistent with the current view of inflation risks. The aim of policy is to anchor inflation expectations more firmly around the midpoint of the target band and to increase confidence of hitting the inflation target in 2024. Guiding inflation back towards the midpoint of the target band can reduce the economic costs of high inflation and enable lower interest rates in the future. Achieving a prudent public debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage growth in line with productivity gains would enhance the effectiveness of monetary policy and its transmission to the broader economy. Economic and financial conditions are expected to remain more volatile for the foreseeable future. In this uncertain environment, monetary policy decisions will continue to be data-dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on potential second-round effects and the risk of de-anchoring inflation expectations. The bank will continue to more closely monitor funding markets for stress. This concludes our statement, and at this stage we would like to invite the media to pose their questions through Zianda. Please limit your questions at your interventions to no more than 3 questions at a time. Zianda, do we have any takers?
Yes, Governor, we have 3 questions from Kopano Gumbi at Reuters.
From?
Kopano Gumbi at Reuters. Which economic indicators would signal to you that hikes are now detrimental and would need to be slowed? At Jackson Hole, Western economies' central bankers said they expected their rate hiking activity to continue for the next 2 years. Do we have market conditions that would have the committee consider a similar course of action? The last question. More developed countries are willing to risk recessions in order to get inflation under control. Does the committee hold a similar view?
Can you repeat that last question?
More developed countries are willing to risk recessions in order to get inflation under control. Does the committee hold a similar view? Thank you, Governor. Those are all the questions for now.
Okay, thank you very much, Kopano. Rate adjustments take place in the context of economic conditions. We have got a price stability mandate, and that is what drives policy. We look at all the other indicators, including what is happening to growth relative to potential, because that tells us the extent of slack in the economy. We also look at other indicators that would impact on the South African economy that could be from the global side. Rates are in response to economic conditions. You asking at what stage do we look at indicators that would tell us that rate hikes are detrimental to the economy. What we do know, what is detrimental to the economy at the moment, is the rising cost of living, which is depicted through inflation. And that failure to deal with inflation now would be detrimental to the economy down the line. And that is what our focus is. I was in Jackson Hole. I do not remember this thing that you are referring to of a commitment to increase rates over the next 2 years. But what we do know is that central banks take their decision from meeting to meeting, depending on changing economic conditions, and recalibrate policy accordingly. I do not think that it would be wise to say we commit that this is what is going to happen, because we do not have a crystal ball that is going to tell us what is going to happen 2 years down the line. As it is, it's difficult to say what is going to happen between now and the November meeting. So we cannot quite make those kinds of commitments. Developed countries risking recession in order to contain inflation. I don't think that any of those economies would deliberately push the economies into recession. But they are faced with rising inflation, and they are having to deal with inflation. They do indicate that in dealing with inflation, there is a risk that the economy could slip into a recession. I do not think that they are consciously pushing their economies into recession in order to achieve particular inflation outcomes. At least, at the very least, that is not what we are doing. And I can't think of another central bank that is focused on pushing their economy into recession in order to deal with the inflation risks.
Thank you, Governor. The next 3 questions are from Pranisha Naidu at Bloomberg. While we understand that the QPM is a broad policy guide, please elaborate on the decision to deviate so significantly from the 5.6% implied policy path by year-end 2022. The SARB has been ahead of the curve when it comes to tightening, as fears that many countries may face a recession as the domestic power crisis intensifies. Are you concerned that you may have to quickly unwind these rate hikes? Please quantify the effect of each 25 basis points hike on inflation and GDP growth. Thank you, Governor.
Chris, the last question is yours, the quantification. Pranisha, we do not obey the QPM. It is an input into our decision-making process. But in case you forgot, let me remind you of your questions in 2020, when we deviated from the QPM and front-loaded the cuts in interest rates. It was, and we said then, that this committee makes a judgment. We cannot outsource our decisions to a model. We are facing exactly the same situation now. The model says 25 basis points in November, nothing now. But the committee's assessment is that failure to act timeously would result in a situation where we might have to make bigger adjustments down the line with consequences for the economy. So the QPM remains just that, an input into the deliberations of the MPC. Ahead of the curve, well, if you look at the inflation outcomes, with the benefit of hindsight, we were not quite behind the curve. We might have been, we were not quite ahead of the curve. We might have been on the curve, but we were definitely not ahead of the curve. We might have tightened before the advanced economy central banks, but Latin American central banks tightened policy way ahead of us. Why have we not followed the Latin American countries? And why have we not followed the developed countries? It's because we assess the developments in the South African economy, the risks attendant to growth and to inflation, and then calibrate our policy accordingly. And this time is no exception. And that is why we say we take this from meeting to meeting. Chris?
Thanks.
Your microphone on. Yeah.
I have no idea. So thanks very much. So holding everything equal, 75 basis points.
He asked 25 basis points.
Sorry?
He said 25 basis points.
25 basis points. Well, it's even less. It's 40% of 25 basis points gives you the growth deduction that the model says will come from the repo increase of 25 basis points. So it's not a lot. I mean, it is worth noting that our growth forecast for this year is shaped primarily by the shocks to the economy in the second quarter. And the longer-term forecast is actually up a little bit relative to our previous forecast. Thanks.
Three questions from Spelele Dludla at Business Report. The governor said that two members of the MPC preferred a full 1% increase in the repo rate. Can he tell us what was the rationale of these members to prefer such a drastic increase? Does this mean we could expect a 1% increase in the remaining MPC meeting for the year, as inflation risks are assessed on the upside? Thank you, Governor.
Thank you very much, Spelele. Members express preferences in the MPC. We deliberate, and eventually we make a decision. The case for why rates could have gone 100 basis points or why they had gone 75 basis points are all reflected in the statement. They are the consensus view of the economy in terms of this committee, in terms of our take on the balance of risks. Members might then prefer that maybe we should be acting faster, and members might say that, well, we act now, we will act later. But what you have in this statement is the collective view of this committee. What does that mean for future rates? When you come in November, you will know what it means for future rates.
Thank you, Governor. We have no further questions.
Well, thank you very much. That concludes the business of today. Thank you very much for your attendance.